Hey everyone, welcome back to the channel. Today we're diving into GameStop and the recent social media obsession about its cash hoard, misconceptions about how that cash is valued by the market, and tackling a big question on everybody's mind. Is GameStop really undervalued at $23 a share, especially considering its cash pile? Or is it properly valued? Retail investors are hyped, but big players, not so much. Let's break down the misconceptions around GameStop's valuation, focusing on that cash equals market cap claim that's going around right now, and why instead metrics like EPS, ROIC, ROA, and ROE tell a different story. Buckle up, this is going to be a quick ride. First, let's address the cash equals market cap argument and the fact that people seem to think that is bullish. While social media and YouTubers obsess over GameStop's cash versus market cap, to me, this is very misguided and it distracts you from what big money who is driving GameStop's price actually cares about. The market cares about two words: net cash, which is the company's cash minus its total debt. And with GameStop's recent $1.5 billion and $2.7 billion bond offerings, they now have about $4.2 billion in debt. After crunching the numbers, GameStop's net cash, the cash minus debt, is roughly about $4.4 billion or $10 net cash per share. Now, I get it. At $23 a share, with the stock trading close to its total cash, it sounds like a steal. And that's why people want you to focus on that. Retail investors love that story, of course, because it suggests you're getting the business almost for free. And the problem is this is a bit of misdirection foisted upon you by people on social media because they don't want you to focus on what professionals care about. And beyond the focus of cash versus market cap and net cash, the real story is a stock's valuation isn't just about cash. Big players, think hedge funds and analysts, focus on fundamentals. And this is why retail doesn't understand analysts' fair price valuations. They're looking at things like earnings per share, return on invested capital, return on assets, and return on equity. Share price is always driven by earnings and expectations of future earnings. GameStop's earnings at a measly 47 cents trailing 12 months annual EPS gives GameStop a PE ratio of 50x. This PE ratio is way higher than the industry average PE ratio of 16 for the sector that GameStop is in. And while some companies that people try and compare GameStop to have very high PE ratios, if you critically look at those companies, they generally have a long history of growing revenues, growing earnings, and very high free cash flow. And that is just not the case yet with GameStop. For the moment, until things change with GameStop, a PE ratio of 50x is just going to act as fuel for short sellers betting on a price drop. According to stockanalysis.com, GameStop's ROIC is very low at 0.84%, meaning that the company is barely generating value from its capital. ROA and ROE for GameStop are also weak at 0.72% and 6.62%, showing poor efficiency in using assets and equity. These metrics scream to Wall Street caution. GameStop's core business is not yet profitable enough to justify the hype, and the cash has not been properly deployed to generate a meaningful change on these metrics that Wall Street cares about. On the bright side, GameStop may be close to pivoting its operational profits as they sell or close underperforming locations. And there's always the speculative bet that management at some point will properly deploy that cash into an investment that generates meaningful earnings and transforms these metrics and ratios that Wall Street truly cares about. And then my friends, then you might start seeing Wall Street value the stock the way that you want them to. And so the purpose of this video is to help educate you and talk about patience and learn to avoid the hype and misinformation that's being pushed on social media, because that is going to frustrate you. Management, I am quite certain, understands all of the finance topics that we just went through in the last couple minutes, and they are stockpiling cash to hopefully fundamentally change and fundamentally transform the future of GameStop's earnings. But until earnings change, you're in a stock which is going to likely be stuck. And keep in mind, we have these big players now with $4 billion worth of bonds, and they're running convertible bond arbitrage strategies, which will suppress the volatility in the underlying ticker. So every month that goes by, every change that management is doing is changing this play. You've got convertible bond traders running ARB strategies. You've got $4 billion of new money, very serious about what happens with this stock and running their particular trading strategies on it. And we might not be in charge of what happens with the price on a day-to-day basis, but management knows what to do. So take a little bit of zen, take a little bit of pause from the loudmouths on YouTube and Twitter, filling your ideas full of things that are meaningless, like OBV, Doritos on the chart, and cash equaling market cap. Wall Street does not care about that. And the sooner you learn to understand how Wall Street is valuing this play, the better your trades will be, the better your entries will be, the better your profit-taking exits will be in this trade. I'm long at $21.61. I will be taking an exit into the next run up. That might not be your strategy, whatever your strategy is. I wish you luck, but I want to ask you, are you listening to people who've done nothing but hold the stock and let profits walk away from them for 4 years in a row? Or are you trying to learn how to make this a profitable trade? If it is the latter, then understand what Wall Street is looking at, and you will better understand how to trade GameStop. I'm Tony Denaro. Thank you for watching, and I will see you on the next video.